Affirm Holdings, the buy now, pay later giant, reported earnings last night, and investors were not happy, sending shares down by as much as 25%. That is a tough pill to swallow for investors. So does that mean that this is a broken company or a broken stock? We'll spend the next 10 minutes trying to figure that out. My name is Brian Stoffel, and as of the time of this recording, I do not own shares of Affirm Holdings. So what we'll be talking about here is the company's fiscal first quarter. That'll be important when we look at the company's guidance moving forward. So going through on the top line, there's a lot of good news. Revenue is up 35%. That was ahead of Wall Street's estimates and at the high end of management's guidance. On the bottom line, loss of 86 cents per share on a GAAP basis. That was worse than management expected, but worse than Wall Street expected, but not by too large of a margin. If we look at how the company did on a couple of key important metrics, looks pretty good. General merchandise more than sextupled. Everything you see there grew markedly except for sporting goods and outdoors, and that's because Peloton, one of the large users of Affirm, has seen their business go in the dumps. It should be noted, however, that a lot of this growth has to do with the fact that the company's partnership with Amazon is still within its first year. Those growth numbers over here on the right will moderate over time. The company, this is at the end of the fiscal year, which was last quarter. You see active merchants ballooned. Amazon, thank you. Active consumers ballooned. Thank you, Amazon. And gross merchandise volume was up 81%. Now, during the current quarter, it was up 62%. So that's still very strong when you consider the general macroeconomic conditions. But again, thank you, Amazon. Now, if we look at Affirm's share of all e-commerce spend, not just buy now, pay later, but all e-commerce spend, we see that it has increased quite markedly, but it is still less than 2%. So there's still a lot of room for growth. And if you look at this, the green line is actually what I want to focus on the most. This is transactions per active customer. We see that it went from 2.3 in the year ago quarter to 3.3. That is an important increase, and it shows that while switching costs per se might not be high, this might be a very sticky product, which could help build a moat around it. It's also worth watching delinquencies. I chose the 60-day delinquencies to watch. We are this black line right here for fiscal 2023, pretty much in line with where 2020 was and slightly better than 2019, markedly better than 2018. 2021 and 22 aren't great comparisons because the effect of stimulus checks were helping out during that time period. And management said, look, a lot of companies are putting their loss reserves up. We're not. We're managing our credit results to do pretty well. And a big part of that is because our average loan is just 4.5 months, which allows them to be flexible in this changing interest rate environment. So why is the stock down so much? Well, what I want to talk about is it really comes down to two things. And I'm going to talk about the business model being unproven, and second, the macroeconomic conditions. Let's take the business model first. So if we look at the company's margins, gross margin, which is a little bit tough to figure out, and I'll show you how I did it, increased to 53%, but look at these operating and net margins. Even though net margin increased, they're both at about negative 80%. That's a business model question. Can they make money? Because if they can't, increasing sales is actually worse. Free cash flow was significantly positive in the year ago quarter. It was still positive this quarter, but by much less so, about $20 million. Net income losses are still large. The balance sheet is upside down, but again, with a company like Affirm, that is a tougher one to make an apples and apples comparison to a lot of other companies that you can invest in. So let's go down the income statement to really get an idea for what's going on here. The amount of revenue they got from their merchant network and their virtual card revenue was up 25%. That's pretty positive. And they have other income streams as well, like their interest income, selling some of the loans, servicing those loans. You add those together and revenue is up 41%. That is very strong. Combine those, 35% revenue growth. Now, this is what I included in gross profit: loss on loans, provisions for losses, funding costs, processing, and servicing. You could argue that that's not a perfect proxy for cost of goods sold, but it's what I used. Now, overall, those costs were only up 14%. Remember, revenue was up 35%. If you've got 14% growth in cost of goods sold, that's why gross margins went up so much. But then we go to operating expenses, and oh, was this painful, with 70% growth, which is double the growth that we had in revenue. Now, a bunch of this was because of stock-based compensation. Shareholders were diluted by 7% during this quarter. If you buy shares, you got to know you will be diluted. That's 7% growth versus the same time last year. So you add that together, and that helps explain why losses expanded by 73%. Now, because of some wonky things with other income and expenses, earnings per share is less meaningful. That operating income is really what's worth focusing on. But here is the second reason. Remember, I said that there was two reasons for the big drop. The first was the business model. We just talked about that. This is the other one. The forecast looking forward, basically the macroeconomic conditions. Management called for top line growth of 14%, whereas Wall Street was expecting 20%, and there's still going to be big losses on the bottom line. Management did say, now they believe that they can be adjusted operating income profitable by the end of this fiscal year. Remember, on a non-adjusted basis, operating income was negative 80%. Obviously, that's better when you take out stock-based compensation, but still, if they can reach that, then they at least prove the business model part of the problems. They did say on the macroeconomic side that the slowing economy, worsening consumer credit, the Fed's rate changes are causing real problems, and it is affecting their business. For the full year, they lowered guidance to a midpoint of 22% growth for the year. Wall Street was hoping for much higher at 27%, and there are still going to be big losses on the bottom line on a GAAP basis. So what should you watch moving forward? Well, there's a whole bunch, but one, watch those operating margins. If they can at least reach adjusted operating positive by the end of the year, big deal. If they can do that while still growing gross merchandise value, big deal. If they can do that while keeping their default rates in a safe area, big deal. And if they can do those three without diluting shareholders, caveat emptor, I don't think that they're going to do that, then that would be a big deal. Overall, I think the moat is stable because look, management is doing what they said they do. They need to follow through on this and prove that it's possible. And the thesis, I'd say, is a yellow flag for just the two reasons I talked about. Macro and the business model still needs to be proven. What about valuation? This is a tough one to value because it's somewhere between stage 2 and stage 3. They're definitely not at break even for profits yet. The income statement is really just optimized for gross profit and revenue, which means we can really only use price to sales, price to gross profit. Price to sales, 2.7. That is high for a company with the margin structure that Affirm has, but pretty low given its historical precedent. And on gross profit, it's increasing. And if we add in the increases from yesterday, it's at about 843 million. The company's trading for about 4.5 times gross profit altogether. So that kind of tells you what's going on here. Look, Affirm is not a company that I'm interested in owning. The business model is not proven to me yet, and I'm not totally certain how wide the moat is around the company. However, the increase in transactions per customer does show that this is stickier than I probably once thought. But those are the two big questions that the company needs to answer for the stock to have days that are less like today and more like where it used to be. They need to prove that this business model can be profitable and that they can survive these macroeconomic conditions. If they do, it could be a great stock to own moving forward. I hope this was helpful. If it was, please give us a thumbs up below and leave a comment and let us know what you think. Thanks, Brian, out.